Today's topic is market cycles and the wave. Now, for those of you that may not be familiar with the wave or market cycles, let me give you a quick background on it, because again, we're going to start off with some more basic discussion and we'll just keep accelerating, gaining momentum as we go through our presentation. So again, first 45 minutes is geared towards more basic, and then we'll keep moving forward, getting more advanced as we get through the 90 minutes. All right, so what is market cycles? Where do they come from? I'm not a history teacher, although I love history, but I think history has little to do with Forex. But I think here it's kind of interesting, and that's because market cycles are things that date back to the writings of Charles Dow, as in Dow Jones Charles Dow. And back when back when Charles Dow had a newsletter, he would write about the psychology of the market, and he would write about it in the sense that there were market trends, okay? And if we were to take a look, for example, at the Euro-US dollar here, and it's kind of obvious today, you know, with the kind of movement we saw, but if I were to ask you, what's the market trend, what's the direction of this Euro-US dollar in the 30-minute chart? I think most of you would say down, correct? I agree. But the question is, at least my question always was, when do I know that? Okay? If I were to push the price action along the right edge and just kind of go a couple candles at a time here, when do I determine, what point do I say, yes, that's a downtrend? You know, where is that assessment taken? Okay? Is it a single candle that does that? Is it the accumulation of candles? You know, at what point can I say the market is heading down in a downtrend? Now, I think some traders might look at a congestion and feel the market has transitioned. And when I say congestion, by the way, I mean a sideways gathering of price action. Things are moving in a range bound. When prices are moving sideways in a range, I think some traders will say, okay, if we break higher through the ceiling or break lower through the support, that's the beginning of a trend. Some traders might say it's when I have a certain number of lower lows or a certain number of higher highs, or, you know, or for other traders it might be when they can actually draw a trend line, a downtrend line across the lower set of highs, or an uptrend across the higher set of lows. Whatever it may be, I think everybody has a methodology by which they identify the trend. For me, I found most of those methodologies were sometimes kind of random, sometimes really lagging, and difficult to do in a very consistent way. To me, you have to be able to read the market in a consistent way. Otherwise, you're going to have a hard time reproducing the results. You're going to have a hard time assessing what the market's doing, trying to decide if you've seen this before, and whether you know the right strategy for that market environment. You know, everything in trading is about going, oh, I've seen this before, and last time I did X, Y, and Z turned out pretty good. Or I've seen this before, and last time I did X, Y, Z, wow, that was a disaster. Okay? So one of the things we want to remember is, as traders, we're looking for consistency, and we're looking to recognize those signs that we are familiar with the price action. Okay? So at what point, looking at this, do we say the market's in a downtrend? Well, I think by this area right here, with these two very sharp moving, sharply downward moving candles, I think most people would say downtrend. But for those of you that are using the wave coupled with the market memory, okay, and what is the wave? The wave is the 34-period exponential moving average set on the high, the low, the close. So that means there's three moving averages. They're all 34-period. They're all exponential, but you're going to set one up on the high, one on the low, and one on the close. And you can do that right within your IBFX platform under Insert Indicators, trend, and moving average. And you can see here, you can set your period to whatever. You can set the MA method to exponential. Okay, so here we're talking about 34 exponential, and then you can see you've got the high, low, and close. And again, you're going to do this 3 times. So you'll notice that I've got a blue, a green, and a red line that represents the high, the close, and the low. That's the wave. And quite frankly, if I would have thought about it, if I ever would have thought that I'd be sitting in front of a room full of people online talking about it, I probably would have given it a better name. But you got to remember, years back, when I'm just sitting by myself talking to my dog and sometimes the television, I just called it whatever was easy. So who knew, right? Anyway, the second thing that I mentioned was look back. And look back is the setting from which you should view a specific time frame. So we're looking at a 30-minute chart right now. In order to, number one, see all the significant highs and lows, the major moves, whether they be rallies or sell-offs, to see the overall market behavior, I need to look at a specific amount of data. For a 30-minute time frame, in my opinion, I want to look for what I find is most useful. I want to look at 1 to 2 weeks. That means I'm looking at basically 5 to 10 trading days. So notice along the calendar axis here, I'm looking at today, the 18th, going back to about the 3rd of this month. So I've got about 15 days, and that definitely works within my 1 to 2 weeks. It's at the higher end of my look back. More is not better. Okay? You want to stick as close to that 1 to 2 weeks. The reason I say 1 to 2 weeks is I think that if you were to take this 2-week look back and make it a 1-week look back, you're still basically looking at the same angle on the wave. You're still getting a good reading of the highs and lows, but you don't want to look at less than 1 week. You don't really need to look at more than 2. Again, this is specific to a 30-minute chart that we're looking at right now. So the reason I'm mentioning the wave and market memory is they are 2 basic steps to before I even begin trying to analyze the direction of the market. And the reason is a lot of traders might look at this view right here. Okay, they might have a very expanded view of the market. That's not necessarily bad, and if the downturn is sharp like it was today, you're still going to get a pretty weak reading. In other words, you're going to see that the market is weak and the angle is pointing downward, and you'll probably come up with the same assessment about the market cycle. But what if we don't have as dramatic a sell-off as we had today? Because I mean, today was a pretty dramatic sell-off, right? We basically moved nearly what, over 200 pips today? What if we don't have a 200 pip sell-off? More subtle sell-offs, smaller sell-offs will not be as clear to read if you get out of the market memory. Okay, most traders have a very random amount of data they look at. That's just been my experience watching traders and teaching traders for, gosh, well over 10 years. Okay, watching myself for 20. Okay, these are observations that I found that, again, if I don't have the consistency of what I'm looking at in terms of data, how could I even have consistency in my analysis? So if you're looking at a 30-minute chart, 1 to 2 weeks. It doesn't mean you need to stay in this view the entire time, but when you're trying to determine the last sell-off or rally, significant highs and lows, if you're drawing trend lines or looking for patterns, certainly if you're taking an angle reading of the wave indicator, you should be in the look back. Once you've done those things, then feel free to go ahead and expand out of it to whatever might be visually more comfortable for you. Okay? But make those assessments first. All right? Okay, so going back to when